Well, welcome to Chapter 18, Financial Statement Analysis. We're going to have a look at what makes companies tick in terms of their profitability and if it's good or bad. Let's have a look. So there's sort of three ways that you can analyze financial statements. One's called a horizontal analysis, which is really a year-to-year comparison. Another one is a vertical analysis, where we look at companies from sort of the top line in sales down to net income or total assets to total liabilities and shareholders' equity. And we can also look at it in terms of some specific financial ratios, which we'll get into here later. But yeah, they're valuable in terms of measuring success in companies. Now, horizontal analysis really is just, it looks at the percentage change in comparative numbers. So if 2014 is the base year, we look at that and say, well, what's the percentage change between that year and 2014 or 2015 or 2016? And we'll show you some examples of that. So here's one that we've got. We've got Spin Master here, where they've got sales of, in 1 year in 2015 was $879.4 million. In 2016, it's $1,154 million. How much of an increase is that? Well, in dollars, that's $275 million increase, which is a 31.3% increase in sales. Same thing with cost of sales, gross margin, all important numbers to understand. This is the base year that we're looking at and how things have changed relative to that. So if we go through here, a couple other ones, there's the same sort of analysis right there in terms of the percentage increase. When we look at some of the expenses, again, when 32% was roughly the increase in sales, we expect to see that in many of them, but look at this, administrative expenses only increased by 2.6%. That's really quite interesting. And look at the bottom line here. It increases from 47 to 99.5. So that's an increase of 111%. Really good numbers. Yeah, they've done well. We can do that also with the balance sheet. So with the balance sheet, we can look at this and say, okay, relative to 2015 base year, what's happened? Well, cash has gone up to $99.4 million from $45.7. That's an increase of $53 million, but more than anything, it's 117.5% increase in cash. That's pretty impressive, other than maybe they should be investing their cash into something else, like inventory. Their inventory is up about 62.7%. Well, maybe they're doing okay there. But you can see how you get sort of an increase, or you can look at the percentage increase and understand a little bit about how things have changed from the base year. Same thing happens here. You can see same deal on terms of liabilities. We see that it increases between the 2 years by $234 million, which is a 133% increase. That's pretty big in terms of current liabilities, where we've actually seen a decrease here in loans, in longer term loans. So they've made things more current. Then we get in here and we look at sort of the total in terms of shareholders' equity. Shareholders' equity has grown by $169 million, which is a 108.3% increase. Big increase. So that's great. When we look at trend percentages, we can do that by, again, looking at multiple years and just seeing how we've done relative to that base year, whatever it is. Let's take a look at an example. So in this case, you can see how we've got 2013 and we got product sales going from 576, say it's million, 576 million to 811 million, 982 million, 1,254 million. So as a percentage increase, you can see right here on the product sales, if 2013 is the base year, then that's 100% of whatever it is. Look at the increase, 140%, 170%, 217%. That's really cool. That's a 30% increase and then a 40% increase. So the trend is looking really, really good in this company. Now, vertical analysis is a little different. Instead, we're looking at things more in terms of a base figure, like sales or total assets. How do things look relative to those numbers on the income statement with sales and balance sheet for total assets? And let's take a look at an example here. So here's a company where we've got 2015's the base, sales is the base, and it's 100% of the total sales. We can see that the cost of sales is 48.3% of the sales number. That means the margin is 51.7% of sales. And we can look at that and compare that year to year. And you can see how 2015 was a slightly better margin than it was in 2016. It doesn't recognize the difference or increased amount of sales, but it tells us we didn't do quite as well on our margin. Pretty close, but not quite as well. And then we get into other analysis here, like selling costs, 21%, administrative expenses, 17% of sales. That's quite different than the prior year where it was 22.3%. So you can get some interesting analysis here, understanding, and none of this is exclusively perfect. It just gives us more and more information that we can look at in analyzing companies. So it's all relative in terms of the changes. We can see the gross margin increased from 458.9 million to 596 million. That's pretty good, but as I say here, the margin is not quite as good as it was before. Now, we can do the same sort of vertical analysis and use total assets in each year as our measuring stick. So total assets in this case are 753 million in 2016. Cash at this point was 99.4 or 13% of the total assets. Having a look here in 2015, cash was only 11.8% of the total assets. So we had more, looks like we had more money invested in cash and receivables in these 2 years than we had in inventory and prepaids. So again, very interesting, just one component of the analysis. We can do the same thing here, and again, we're comparing it to total assets. And you'll see that as a percentage of total assets here, current liabilities are 54% in this case, in this year, versus 45.1% in the prior year. So it's kind of interesting to see how those have changed here by looking sort of vertically in this case. Now, when we use those, when we want to sort of analyze different companies, sometimes using these common size financial statements makes them work better. What it does is it gives us benchmarks or gives us numbers that we can use and say, okay, one company here has got all this cash, and this other company has less cash and more inventory. Is that good? It's just more information for you to use to decide on how you'd like to invest. But it's usually a good idea to do that. Both income statement and balance sheet, we need to look at them and do that vertical analysis to compare between companies for sure. So in this case, we can sort of look at these as a percentage of total assets. In this case, Spin Master, we can look at this and say, okay, well, Spin Master has these percentages in cash and receivables and inventory. How does that compare? From year to year, we can tell, sort of thing, but I wonder how that compares to other companies. And that's part of benchmarking, actually, is trying to look at a company and saying, okay, this is my company that I'm in right now. How does that compare to, say, one other company or to an industry average? benchmarking is all about that, trying to understand that sort of thing, so that you can look at the success of your company and say, you know what, I think that's a great bank, and when I compare it to another bank, it looks good, and I compare it to the average bank, it looks even better maybe. But it gives you something that you can actually start with to do your analysis for sure. You can get all that benchmarking from annual reports or quarterly reports. Newspapers for sure have that sort of stuff from time to time. Credit agencies, other financial databases, CDAR sometimes has that sort of stuff. All sorts of good information is available there. And then you can get into making some active decisions here. So again, here's an interesting analysis here of Gildan Activewear and Canada Goose. Who's got what invested in what sort of thing. Or in this case, who's got the best margins as a percentage, who's got the highest selling costs, that sort of thing. You'll see how it's quite a bit different here between these two companies. The Gildan has very low margin, but very few selling and admin expenses. Canada Goose, huge margin, but their selling and admin expenses are fairly significant. So as a percentage, you probably say, well, Gildan looks better. That's an interesting one. All right, hope you enjoyed this part.